Hey, this is Warren Redlick. I want to talk to you about Tesla stock options, specifically long call options looking out 2 years or more, and how you might be able to use this as a tool to increase your long-term return in Tesla with taking on significant risk. I'll start off by saying, of course, this is not financial advice. This is something that I've been wandering through, and I wanted to share my approach. Many people have told me they don't like my approach. This approach may not be right for you, but the basic idea is you invest less than 10% of your portfolio in something that has potential for significantly larger returns. In my case, investing in a Roth IRA with the idea being that when you draw the money, it will be tax free. So you want your biggest gains in the account that will be tax free. Now, maybe Donald Trump is going to eliminate income taxes and Roth IRAs are a terrible idea. But right now we still have, I'm already doing this. I was already in the Roth IRA. So it's too late for me if he does that. But I just wanted to give you, this is sort of like a straightforward example. I'm not going to give you a theory. I'm just going to give you a straightforward example. So I was looking at this on the weekend. The stock closed at $355.84. And I looked at several different options choices. All the options I looked at were expiration June 17, 2027. The strike prices I did range from 400, 500, 600, 700, and 800. These are all what are called out of the money options. The strike price is higher than the current stock price. And you can see what the prices were for the different options as I looked at them. I didn't buy any of these. I already have my options purchased. I don't think I'm buying any more, but I just wanted to go through with you what I'm doing and discuss why I'm doing it and give you a sense of what the choices are when you do this. So let me just explain first of all, what does this mean? Okay, so here you buy an option. Let's say here it's in each of these cases I did quantity one. When you see what I do, depending on which option you choose, you end up buying more. I'll explain that in a minute. But for now, let's just say it's strike price of 400, June 17th, 2027. So you buy one option. One option contract means an option to buy 100 shares of Tesla stock at the strike price on the strike date. So the strike date is June 17, 2027. So on June 17, 2027, if I buy this option, I can then buy the stock from the person who sold me the option or whoever holds it now for $400 a share. If the stock is trading at $400 a share or less on that strike date, the option is worthless. If the stock is trading above 400, but not much above 400, then you exercise it and you make some money, but you make less than what you spent buying the option. So you can see here, the price is about $121 for the option. That's $121 per share. So it's really $12,100 to buy this one options contract. And these are things that I did not understand when I first started this more than a year ago, maybe 2 years ago. I understand it now a little better, and I'm hoping I'm explaining this okay to you. So, in other words, you pay $12,100 if the stock is trading at $420 a share, and you make $20 a share times 100 shares, you made $2,000, but you paid $12,000 for the option, so you actually lose $10,000. If the stock is trading at $500 a share, now you make $100 a share, you make $10,000, and you still fall short of the $12,000. And I'm going to show you this in a chart in a minute. The higher you go in your strike price, what happens is the lower the price to buy the option now, and the more options you can buy with the same money. The example I'm going to show you is where you're spending about $100,000. So if you're spending about $100,000 and the strike price is $121 a share, you can buy 8 options. If the strike price was, let's say, $50 a share, here it's 56. If it was $50 a share, you could buy 20 options. I hope this makes sense. You're buying 100, right? So that's the balance of what you're doing here is how many can I buy? And then if you bought at an $800 strike price, now the stock has to be over $800 for you to make any money at all, even though you might lose some, and it has to be significantly higher. The game, as you'll see, is if the stock goes really high. This was my expectation, and I did the math, and it turns out I'm right. If the stock goes really high, then buying at the higher strike price, you make more money. So I'm going to show you that in a minute. So this is the spreadsheet that I came up with. Thank you for watching this intro to the video. If you'd like to watch the whole video, please subscribe to me on the X platform, become a YouTube channel member, or support me on Patreon, or support me on the Daily Lie, warrenredlick.locals.com, and check out the t-shirts at elonbits.com. Thank you.